Hi, I'm Rick Kaler. Thanks for joining me. Is there anything more important than the overall rate of return you earn on your investment portfolio? Well, as you might suspect, there is. It's the real rate of return. Over the past 5 years, even diversified portfolios have earned relatively low returns. Many investors are fearful that this has significantly reduced the income that they can expect to receive upon retirement. To see whether that fear is completely justified, let's look at some numbers. Based on a model portfolio that I follow that holds 9 different asset classes, the average return for the past 3 years, and this is after all fees and expenses, was 2.45%. The 5-year return was a little better at 2.67%. But the 7-year return looked pretty nice. It was 5.62%. If an expected long term, which I would say would be 10 years or more, overall return on the same portfolio was 5%, at first glance it appears the portfolio slightly exceeded its expectation for 7 years, but fell way short the last 3 and 5 years. I mean, almost half. But you know, if there's a first glance, there is a second glance coming. And that second glance highlights a seemingly obscure fact that significantly changes the picture. In every future return expectation, there's also another estimate that is rarely mentioned, but which is as important as the rate of return. This is the rate of inflation, or the projected or assumed rate of inflation going forward. While in the example above, the long-term expected overall return was 5%, the long-term expected rate of inflation was 3%. This means there was an expectation the investments would earn 2% above the rate of inflation. 5% the expected return minus 3% the expected inflation rate leaves you 2%, which is the real rate of return. And this is far more important than the overall rate of return. For example, if the projected inflation rate was 4 and your overall return rate was estimated at 5, the expected rate of return, the real rate of return, would be 1%. At a projected inflation rate of 6%, the real rate of return would have actually been negative, been a -1. Most financial planners base their projections of a client's retirement income on the real rate of return. A real rate of return of 2% is pretty common from my perspective. So taking into account the real rate of return, what has actually happened over the past 3, 5, and 7 years? Overall expected returns have definitely been lower the past 3 and 5 years. So has the inflation rate. While the estimated inflation rate was 3%, the actual inflation rate was significantly lower. It was 0.78% for the past 3 years, 1.03% for the past 5 years. Subtracting these numbers from the overall rate of return, so the 3-year portfolio earned 2.45%, so we subtract 0.78, and the 5-year model portfolio was 2.67, so we subtract 1.03. That leaves us with 1.68% real return over 3 years and 1.64% real return over the last 5 years. Now, compared with the estimated real return of 2%, it's slightly lower, but it's closer to hitting the target than not. Looking at the 7-year rate of return, things go from okay to phenomenal. While the overall rate of return was 5.6%, which was higher than the expected rate of return of 5, the inflation rate was 1.03 instead of the 3% that was expected. This resulted in a real rate of return of 4.59%, more than double the expected rate of return. So the bottom line of all these numbers, and I can appreciate for you that struggle with numbers, well, lots of people do. Bottom line is that those investors who've been in the market for 7 years will have more to spend in retirement than previously projected. In investment circles, this is called a home run. For investors discouraged by recent overall return numbers, a second look might give you cause to cheer up. If you're invested in a diversified portfolio, you rebalance, and you've stayed the course during market crashes, things may be better than they really seem. Thanks to one of the lowest inflation rates in modern history, you could be further ahead than you thought. Thanks for joining me.